After years of waiting, a rate cut finally came. But what does it mean now? Here to talk about what this rate cut means for the market going forward is market beat analyst Thomas Hughes. Thomas, let's start off with just how much of a rate cut we saw. Was this kind of a surprise for some people?
I think it was a surprise for some people, but not a great shocking surprise for the market. I would say that there was about a 50-50 chance for 25 basis points or a 50 basis point cut. What I would say is they started out aggressively, which you can tell by the headlines. The market is pretty much in agreement with that. We've had an aggressive start to the rate decrease cycle.
And it's been a long time coming. The market, bet many investors have been waiting and watching for this cut for years. It's been very much expected this time around, but you're right. I think that 50 basis point cut is more than some people were expecting. Talk about how the market is reacting to this aggressive approach.
Well, the response has been pretty volatile. I mean, initially the market surged higher, set a new high, but then it quickly sold off and closed lower for the day. The following day, futures indicated a strong open, in which we've gotten, but the market is now struggling to move even higher. So I think that there are still a lot of swirling factors in play, and the market's trying to figure it out.
Absolutely. Let's backtrack a little bit and talk about why do you think the Fed went with that 50 basis point cut?
Well, right. So this goes into the idea of volatility and who's right and who's wrong. The aggressive 50 basis point cut could mean that inflation is cooling, the economy is solid, there's no risk of recession, soft landing will happen sooner, and the Fed will usher in that economic shift that we've been talking about more quickly than we've been expecting. However, they might be trying to front run a recession, which is bad news for the market. In that case, no amount of cutting will stave off the recession or an ensuing market decline. It's just a matter of wait and see right now.
Yeah, what do you think we're going to be seeing in the market in the days and weeks to come?
I think we're going to see a lot of volatility. Right now, the market needs either confirmation that we're okay or confirmation that we're not okay. So every data point is going to be a market mover, especially the labor data. The labor data has been softening. If it continues to soften over the next month, I would not expect to see the S&P 500 move significantly higher.
You've talked a lot in the last few weeks, Thomas, about walking that tightrope, and the Fed is trying to avoid the recession, but also try to keep inflation in check. Is that what they're trying to do here? And do you think it's going to have an impact on inflation down the road?
I think this is the case of be careful what you wish for because you just might get it. The aggressive pace of cuts could signal soft landing, but it will also help reaccelerate the economy and help sustain inflation. So ultimately, I think that's bad. I think that we may have a higher for longer inflation situation still in place. I think the Fed may be exacerbating that situation.
I also want to point out that you've been predicting volatility for weeks too, and I think that's exactly what we're seeing with this rate cut. It didn't just magically solve some of the economic concerns and issues that people have. How long do you think the market could be in this volatility stage?
I mean, it could last for months. You have to remember that the situation we're in is the result of not just the last 2 or 3 years of stimulus spending and inflation, but also the preceding 10 years of easy money policy and the Japanese yen carry trade. The carry trade is really significant because that's been building up for years, people borrowing money from Japan to lend to the United States. And that money has to come back and be paid back to Japan, which means that there's going to be a lot of selling. So I would expect any market uptick to be followed by a downtick as people sell into the rallies. But again, so far as the soft landing scenario is still in play, any downtick should also result in a buying opportunity for stocks that are presenting values.
Yeah, let's talk about that a little bit more. What does all of this volatility mean as far as potential opportunities for traders?
Well, right now, with recession not on the table, I mean, it's on the table, but it's just a risk. It's something we're worried about. It's not up in our face. I would expect the market to move sideways with that same dynamic I just described, selling into the rally to take profits and close out the carry trade, also moving to flight to safety. But any downtick should result in a buying opportunity as people focus on their values. Now, the big risk is that the labor data or other data will start to point more significantly towards a recession, and in that scenario, we might start seeing more intensified selling, more flight to safety selling, more risk off selling, and that could lead to a more significant market downturn.
Yeah, in your article that you wrote, which I'll link to here, you also talked about this rate cut is going to take months potentially to even be reflected in the data. Talk about that a little more.
Well, right. It's generally accepted that it takes 12 to 18 months for a single 25 basis point cut to fully impact the market. So we're looking at a quarter or two before we start seeing significant changes in the data, which gives us 6 months of upcoming PCE, CPI, and labor data that is going to drive volatility. As I said before, any good news is going to cause the market to go higher, but any bad news will cause it to move lower.
And one last thing I want to close out with today. This is the first rate cut we have seen in years, but some people are predicting potentially even more yet to come. Do you think we're going to continue to see this aggressive approach?
Well, the Fed has indicated that. They've indicated that they want to cut another 50 basis points by the end of the year and another 100 points next year. And if they do that, it just plays right into what I've been saying. They're either going to usher in that economic shift sooner than we expected, or they're trying to front run a recession. And again, we're just waiting for the next few months of data to understand, are they actually going to cut more, or do they need to keep rates where they are now, or possibly even raise them back up again if inflation starts to rise again? Because you have to remember, there's still a lot of demand in the economy. Consumers are still spending, even though the housing market is pretty crappy. Um, People want to buy houses. So if the price of houses starts to fall, inflation or interest rates start to fall, it's going to spur demand in that sector. We can already see oil prices starting to move back up again. All of those things play into inflation. I think that ultimately we're still walking that tightrope. The Fed still has plenty of risks. We're still data dependent, and the next few months are going to be very telling.
Well, we will continue to watch how well they balance on that tightrope they're walking right here on Market Beat in the days and weeks and months to come. Thanks for joining us for this market analysis, Thomas, and thank you for watching Market Beat Media. Subscribe and like our channel, comment, and join the conversation to stay tuned for more market news right here on Market Beat. As always, happy investing.